Why are bonds used within a portfolio framework? Generate income, negative correlation, and more importantly, diversification. Article in Vanguard talks about how bonds create a counterweight or counterbalance to a stock portfolio. There was recently an article in USA Today that talks about it serves as a ballast to counterweight the relative normal volatility of stocks. Forbes goes on to say that in 2018, both bonds and stocks were moving together. Stocks were down about 10%. The bond market was down about 2%. And he goes on to say that bonds are helpful in defraying the risk of stocks to decline about half the time, but does not offer any degree of certainty. Now, this is really the key, degree of certainty. Diversification works fine until markets become very volatile. We saw that in 2008 where correlations started to move together, everything started to drop together. The average portfolio mix, according to Dr. Markowitz and Dr. Sharp, who really came up with modern portfolio theory, talked about how a 60-40 stock bond mix tends to give you the most upside and the best diversified hedge on the downside. The question is, on a 60-40 stock bond mix, how much can I expect to make on the upside? How much can I expect to make on the downside? Well, approximately over the 8 years, you captured about 42 to 44% of the upside when the market was going up on a 60-40 stock bond mix. And you would capture about 50% of the downside as the market came down. Interestingly enough, in 2009, that was about what you captured. A lot of pensions, a lot of endowments have been underperforming because of diversification models. Remember, if in a 60-40 stock bond mix, if the market's up 10%, and they're only capturing about 40% of the upside, they're capturing about 3.5–4%. Unfortunately, that's not giving enough return to achieve that 5 to 7% return a lot of the pensions and endowments would like to see. There was an article in the Financial Times talking about the set it and forget it strategic models just are failing to really give the returns that these big pensions endowments would like to see. In fact, even Warren Buffett talks about why diversification is only required when investors don't understand what they are doing. Is there a better way than diversification to run money, to manage risk? Well, can we use insurance? Can we use a tool that was invented to manage risk in the stock market? We insure our cars, we insure our homes, we insure our life, we insure our health. Why can't we insure our financial assets? Well, you actually can do that. You can do that with something called a protective put. Why don't more people do that? Is it not efficient? Is it impossible? Or is it too costly? The norm is that it's too costly to insure an average portfolio, let's say over a year, with a protective put strategy might cost as much as 8, 10, 12%. That's far too much money to pay to protect a portfolio. So most people, most professionals don't use this idea of asset protection. One of my favorite quotes is by Albert Einstein. He said, "True genius is applying imagination to knowledge." Here at IPS Strategic Capital, after years and thousands of hours of research and dedication to really this subject, we've been able to really develop a hedging strategy, not a diversification strategy, a hedging strategy, which means actually using hard insurance, i.e. protective puts, to do a much better job of managing risk than, let's say, putting 40% of your money into bonds to try to create some type of lower volatility portfolio.
What we've been able to do is create a strategy that provides the protection with a much smaller carry cost associated with it. And what that allows the investor to do is to take more risk on the equity side of their portfolio.
We call it IPS Bear Strategy. Now, what's exciting about this strategy is it really provides a lot of upside opportunity when the markets come down in a very defined way. But yet when the markets are going up or flat, the strategy holds value or loses a lot less money.
We're actually able to overlay the strategy on top of an existing equity portfolio. So it makes it very easy for the investor to access this type of strategy since we can run it on top of their existing equity holdings.
We use no technical, no fundamental, no qualitative triggers within this strategy. It's 100% rules-based. It has a downside beta of negative 1.74 and an upside beta of negative 0.30. What that means to you is that typically when the market's down 10%, we expect this strategy to be up over 17%. And if the market is up 10%, this strategy will be down about 3%.
That asymmetry, unlike a 60-40 conventional portfolio, helps you to put a very tiny amount of your portfolio into this hedge strategy and still get a better hedge on big drawdowns in the market. And because you're putting less amount of your portfolio into a hedge, it gives you better upside capture.
In fact, from 2008 to 2019 current first quarter, this particular 80-20 IPS Bear Strategy and 80% in the S&P 500 would have annualized at over 10.6% a year. Now, this is based on very, very detailed historical regressions. Whereas a 60-40 mix would have done just about half that, 5.24%, and the S&P would have come in at 8.33%. The terminal value of using an overlay as opposed to a 60-40 mix is tremendous to actually pick up about 500 basis points a year. Now, it currently is not available in an IRA account because it is an overlay using options. However, it is available within an IRA package with the long option exposure within a publicly traded mutual fund that is available through IPS Strategic Capital. Direct hedging with insurance protective puts defines our risk today for tomorrow, and that's what we've been able to accomplish at IPS Strategic Capital.